Okay, it is 10:35, hence we will start to discuss the solutions now. What? Yes. So at the end of the day today, after the last group has had their seminar, I will send this file to you to your group email address. In addition, I will upload this file with these solutions to Google Disk. So exercise 1, we have issued a financial liability at a discount where the initial value of cash received is less than par value. Hence, over the lifetime of this financial liability, we have to increase the value of this liability on the balance sheet so that its value as of December 31st, 2020 is 100. Hence, in each journal entry, we have 3 items: 1 a debit expense, 2 credit cash, and 3 a debit to increase debt, 4 interest expense minus cash. In each year, the value of interest expense is the beginning value for debt multiplied by 0.12 from the effective interest rate of 12%. For example, on December 31st, 2018, we have beginning debt of 85.59. We multiply this value by 12%, hence interest expense 10.27. Based on interest expense of 10.27 and cash paid of 6, we have a credit or an increase in debt of 4.27. The journal entries for 2019 and 2020 are the same. Hence, as of December 31st, 2020, when we repay the principal on this debt, we reduced the value of this debt in the financial statements to 0. So this is exercise 1. As we are going through the solutions, if you have any questions or if anything is unclear, please write your question in the chat or just tell me in the microphone. So this is exercise 1, interest expense. Exercise 2, we have a financial asset, a debt instrument that we purchase at a premium, where the initial value of this bond on the balance sheet, 105.15, is greater than par value 100. Hence, over the lifetime of this bond, we have to reduce its value so that its value as of December 31st, 2020 is 100. Therefore, each date we have 3 items in the journal entry: 1 debit cash for cash received of 10, 2 credit interest revenue, and 3 credit bonds or reduced bonds for debit cash minus credit interest revenue. So in each year, the value of interest revenue is the beginning value of the bond multiplied by the effective interest rate of 8%. For example, 2018, we have a beginning value of 105.15 multiplied by 8% or 0.08. We have, hence, interest revenue is 8.41. Therefore, we have debit cash 10, credit interest revenue 8.41, hence credit or reduced bonds by 1.59. The journal entries for 2019 and 2020 are the same, or have the same items. Hence, as of December 31st, 2020, when we receive the principal repayment for this bond, the value of this bond on the balance sheet is reduced to 0. So that is exercise 2. So if there are no questions on exercise 1 or 2, we will go to exercise 3, where we have debt securities or debt instruments classified as held to maturity, available for sale and trading. First, held to maturity. As of December 31st, 2018 and 2019, we recognize impairments based only on expected credit losses. And hence, in 2018 and 2019, when we have expected credit losses of 20 and 10, we recognize in net income or profit and loss an impairment loss of 20 and 10. In each year, this impairment loss is recognized in this contra asset, a loss allowance, or the allowance for credit losses. For January 1st, 2020, when we sell this bond for 910 in cash, we debit cash 910 cash received. We debit the loss allowance for 30. Cumulative expected credit losses for 2018 and 2019, 20 and 10. We credit or reduce the value of the bonds by 1,000, gross value as of January 1st, 2018. Hence, we have a net value of 970, gross value 1,000, minus loss allowance 30. Therefore, we have received 910 in cash for an asset with a net value or a carrying value of 970, hence cash less than carrying value. As a result, loss on sale for net value or carrying value 970. minus cash received of 910. Let's held to maturity. Next, available for sale. For December 31st, 2018 and 2019, we divide the decline in value into two parts. One, the decline in value from expected credit losses. We recognize an impairment loss in net income or profit and loss. The other part, the decline in value net of or not related to expected credit losses. We recognize an OCI. For example, 2018, we had a total decline in value of 30 from 1,000 to 970. Of this decline in value of 30, 20 was from expected credit losses, hence impairment loss, net income 20. The other 30 minus 20 or 10 was recognized in OCI, hence lost OCI 10. It's the same type of thing for 2019. For 2020, we have two journal entries from the sale of these bonds. First, we de-recognize the bond and recognize a loss on sale. We debit cash for 910, cash received. We credit the bond for its carrying value of 930. We had January 1st, 2018 plus 1,000, but a decline in 30 and 40 on December 31st, 2018 and 19, hence 1,000 minus 30 minus 40, or 930. Therefore, we have received 910 in cash for an asset with a carrying value of 930, hence cash less than carrying value. As a result, loss on sale for 930 minus 910 or 20. The second journal entry is for recycling. In total, we had cumulative losses in OCI of 40, 10, and 30 in 2018 and 2019. On January 1st, 2020, we sell the bond, hence we recycle these losses from OCI to P&L. As a result, debit loss P&L, credit gain OCI for 40, the value of these cumulative losses from OCI that have been recycled to P&L. So next, trading, where these debt instruments are valued at fair value through profit and loss. Hence, for December 31st, 2018 and 2019, we do not divide the decline in value into two parts, P&L and OCI. We recognize everything in P&L. In 2018, the value of the bond declined by 30 from 1,000 to 970, hence loss P&L, debit loss P&L, credit bonds 30. For 2019, the value of the bond declined by 40 from 970 to 930, hence debit loss P&L, credit bonds for 40. The journal entry for January 1st, 2020 from the sale of these bonds is the same as for the sale of the bonds with available for sale. And that is exercise 3. So if there are no questions on exercise 3, we'll come to exercise 4, where we have a derivative with a cash flow hedge, where the hedging instrument is the intrinsic value of the option. So January 1st, 2018, we pay 300 in cash for an asset, hence we debit this asset derivatives, credit cash 300. For March 31st, June 30th, and September 30th, we have this journal entry to recognize a change in the value of the derivative and to recognize this change in value in OCI. These changes in value are divided into two parts, one related to the intrinsic value, the other related to the time value. If you look at this under point 1, under intrinsic value and time value, the intrinsic value and the time value as of each date are shown. So below, in the rest of this explanation below, it shows how these values are calculated. For now, we will focus only on using these values to determine the gains and losses recognized in OCI. So as of each date, we have a CFH gain or loss, or cash flow hedge gain or loss, for the change in the intrinsic value of the option. In addition, we have a TVO loss, or time value loss, for the change in the time value of the option. For March 31st, 2018, the value of the derivative increased by 200 from 300 to 500. Hence, we debit this asset derivatives for 200. But this increase in value consisted of two parts. One, a change in value from intrinsic value, the other from time value. For the intrinsic value increased by 300 from 0 to 300. Hence, we recognize a gain for this increase in the intrinsic value as a cash flow hedge gain. Hence, we have CFH gain 300, the increase in the intrinsic value of the option. But the time value of the option declined by 100 from 300 to 200. Hence, we have time value loss 100. As a result of this total decline in value, or this total increase in value of 200, we have a increase in value of 300 from intrinsic value, but a decline in value 100 from time value. For June 30th, 2018, the value of the derivative declined by 250 from 500 to 250, hence credit derivatives 250. This loss or this decline in value is divided into two parts. One, intrinsic value, a decline in value of 150 from 300 to 150, hence CFH loss debit 150. Time value declined by 100 from 200 to 100, hence debit time value loss 100. September 30th, 2018, we have 4 journal entries. One is to recognize revenue from this sale of steel, where we sold 30 tons of steel for 8 per ton, hence debit cash credit sales revenue for 30 multiplied by 8, or 240. The second journal entry is the same journal entry that we had on March 31st and June 30th. First, we debit or increase the value of the derivative by 110. The value of this asset, this derivative, increased by 110 from 250 to 360, hence debit derivatives 110. This increase in value of 110 consists of 2 parts. One, an increase in the intrinsic value from 150 to 360, hence credit CFH gain or cash flow hedge gain 210 for this increase in intrinsic value. Second, we have a decline in time value from 100 to 0, hence debit time value loss OCI 100. The third journal entry is recycling for these gains and losses from OCI into P&L assumed to be recognized within sales revenue. So for the CFH loss, in previous periods, we had total or cumulative gains on intrinsic value of 360. So this CFH gain, we had 300 on March 31st, a loss of 150 on June 30th, and a gain of 210 on September 30th. Hence, in total, net gains of 360. On September 30th, when we sell this steel, we recycle these gains from OCI to P&L. Hence, we have cash flow hedge loss of 360 equal to these cumulative gains from prior journal entries. In addition, we have cumulative time value losses of 300, 100 as of each day. We recycle these losses into P&L, hence time value gain OCI 300. As a result, on net, we had gains in OCI of 60. We had 360 in gains from intrinsic value, cash flow hedge gains and losses, and we had cumulative losses of 300 from time value from these TVO losses. Therefore, we have on net a gain of 60. Hence, we have sales revenue 60, the net gains from OCI that were recycled to P&L. The fourth item in this journal entry is for the settlement of the derivatives. We have settled a derivative that has a positive fair value for us of 360. Therefore, we receive 360 in cash, hence debit cash, credit derivatives for 360. Yes. So that is exercise 4, cash flow hedges, where the intrinsic value of the option is designated as the hedging instrument. So if there are no questions on exercise 4, we will come to exercise 5, where we again have debt instruments. But here we do not sell the debt instrument on December 31st, 2020. We reclassify, or on January 1st, 2020, we reclassify this debt instrument from AFS to trading. So December 31st, 2018 and 2019, we divide the decline in the value of the bond into 2 parts. 1, impairment loss P&L equal to expected credit losses. 2, the decline in value net of ECL recognized in OCI. So this is the same type of journal entries that we had in the previous example. Next, December 31st, 2020, we reclassified the bond from AFS to trading. Hence, we have 2 journal entries. 1 is to reclassify or recycle gains and losses recognized in, or in this case, losses recognized in OCI in previous periods. So as of December 31st, 2020, the bond is reclassified as trading. Hence, if the bond always had been classified as trading, we would not have recognized these losses in OCI. We would have recognized all losses in P&L. Therefore, these 50 in losses from previous periods, 10 in 2018, 40 in 2019, are reclassified or recycled from OCI to P&L. Hence, lost P&L, gain OCI 50, cumulative losses recognized in OCI in previous periods. Next, we de-recognize the AFS bond and recognize the trading bond. So the value of bonds trading is 940. The fair value of the bond as of the date of this reclassification, December 31st, 2020. We credit or de-recognize bonds AFS for its value before this reclassification. Its value is 900. We had plus 1,000 on January 1st, 2018, but minus 40 on December 31st, 2018, and minus 60 on December 31st, 2019. Hence, 1,000 minus 40 minus 60, or 900. Hence, we have recognized an asset with a value 940 and have de-recognized an asset with a value 900. For this difference, we recognize a gain P&L 940 minus 900, or 40. This gain of 40 is equivalent to or the same as the increase in the value of the bond from 900 to 940. So that is exercise 5 with reclassifications. So this is the final exercise for today's session. At the end of the day today, after the last group has had their seminar, I will send you this file by email to your group email address. Next week, we have lectures on Monday. Either tomorrow or sometime this weekend, I will send you these slides for those lectures. So if there are no questions or comments on these exercises or any other aspect of the course, we will be finished for today, and I will see all of you next Monday at the lecture. Yeah, you're welcome.